Thank you, everyone, for joining us today. My name is Ian Abernathy. I am the Senior Vice President of Strategic Relations for Buckingham Strategic Partners. Today, I'm joined by our Chief Research Officer, Larry Swedroe. For many of you on the call, you probably know who Larry is or have heard of him from his various appearances in media, his books, etc. We're excited. I know, Larry, you call these your Swed Talks, and we've had a few of these this year, and I think this one is especially relevant given the interest in sustainable investing and how it's really become a more popular topic among clients and the advisors who work with those clients. And I think oftentimes there's a misconception that there's a trade-off that by doing good in our investments, that we have a trade-off in terms of return, right? And that, so Larry, I know today that's part of the topic we're going to cover is just the fact that trade-off doesn't necessarily exist. And I think we're excited to get it started. So a few housekeeping notes before we jump in. If you do have questions, there's the chat and Q&A buttons at the very bottom. For those of you who are not aware of who Buckingham Strategic Partners is or is joining us as a person who might not work with us today, but be interested in working with us, we are I guess the term TAMP is what officially is used in the industry, but really we're a wealth management platform for advisors. We work with advisors either directly or through platforms, whether it's Orion platform, broker-dealer platforms, et cetera. And we do have a series of ESG and SRI portfolios available for clients to use and access. And there'll be more information about how to reach out and have a further conversation with us towards the end. But more importantly, I want to turn it over to Larry to kick us off. So Larry, why don't I hand it over to you and let you go through the conversation?
Thanks very much, Ian. As you noted, the recent decade and really just the last 5 years, we've seen a dramatic increase in sustainable investing to the point that when I started in this business, probably 1 or 2% was invested sustainably. But today it's already 33% or so of US assets and more than half in the rest of the developed world. And an important question which you touched on is, does this trend influence company valuations and thus the cost of capital of companies, and by implications, returns that investors can expect? When we seek answers to such questions, investors are best served, we think, by learning what economic theory and empirical findings from academic research have to say, rather than relying on opinions. And we'll begin by reviewing the economic theory. We're going to begin with a behavioral-based or a taste-based or a preference-based hypothesis, which is that in equilibrium, screening out assets based on investors' taste should lead to a return premium on those screened assets. And thus favored companies will have a lower cost of capital because they have a higher PE ratio. And of course, the flip side of a lower cost of capital is a lower expected return to shareholders. Of course, there's a flip side to that. The sin companies or the brown versus green companies have a higher cost of capital because they have a lower PE ratio. And of course, again, the flip side of a higher cost of capital is a higher expected return to capital providers. And thus the hypothesis is that this return premium is compensation for the emotional cost of exposure to offensive companies. And investors in companies with higher sustainable ratings then are willing to accept lower returns as the cost, if you will, of expressing their values. This is the behavioral explanation, as I said. In addition to this taste or preference-based explanation, economic theory also provides a risk-based explanation, which we're going to explore now. So companies that neglect ESG exposures could be subject, certainly, to greater risks. And companies with higher sustainable scores actually have better risk management, better compliance standards, and therefore that leads to fewer extreme events such as environmental disasters, fraud, corruption, and litigation. And higher scoring firms then have reduced tail risk, creating this sin premium. If you own the sin stocks, you're taking greater risk of these left tail events or black swan type of events. And in order to accept that risk, you demand a premium, which was reflected in the lower PE ratios. So sustainable investment strategies can also have an impact on portfolio diversification, not just risk and return. And that's because sustainable investors do sacrifice some of the benefits of diversification because their investments are limited to the universe that meet a sustainable investing screening process. So in theory, at least, less diversified portfolios are less efficient ones. So now we're going to try to answer the question, what do investors really want from their sustainable investing? And I found this quote from a paper called Responsible Investing, which I think does the best job of providing the answer, which is that many investors want to own ethical companies in a saintly effort to promote good corporate behavior while hoping to do so in a guiltless way that doesn't sacrifice returns. All right, that's the theory. This is what investors are seeking. So now let's look at what the academic research has to say, beginning with a look at the providers of the ratings that are used by people to make portfolio choices. There are currently dozens of raters, of which there are 7 major providers. You can see them on the screen here. The 2 big ones are MSCI and Sustainalytics. Unfortunately, the correlations of the ratings between the various providers averages just about 0.6, and there's a very wide range, which means the information is what economists would call noisy. And the problem is that this divergence of ratings poses a real challenge for empirical research because the results can depend upon which rater you use. You can get different answers to your questions, whether you use MSCI or Sustainalytics or Trucost or whoever. And the next slide provides a really good pictorial example of just how wide the dispersions can be. You can see you have some scores in the bottom right corner where Sustainalytics gives them almost perfect scores, but MSCI gives very low scores. And you can see things on the upper left side where the reverse is true. And so that begs the question, one would think, why do we get such large divergences in the ratings? And the reason is there's a large variety of inconsistency in metrics purporting to measure the same things. So you can have raters using very different metrics for the similar rating that they're looking at, and it can reflect firm-specific attributes, different terminologies, metrics, and units of measurements. And there are also differences in how you benchmark. Do you benchmark against, the market, or do you benchmark in a best of class kind of sense, where, say, an energy company, which is doing the most work in green energy, would get a top score, versus if you look at the market, they will almost certainly get a low score. Let me dig a little deeper into this for those who aren't familiar. So the wide divergences, as I mentioned, can result from investors using different metrics. So there is something called Scope 1, Scope 2, and Scope 3 emissions. Scope 1 emissions measures the direct inputs into making a product. Scope 2 includes all of the inputs that go into it. And Scope 3 looks at the entire chain and getting it to the client. So for example, if you look at Scope 1 or 1 and 2, Amazon may look very good. And then you look at Scope 3 and you've got all these trucks driving around burning up energy to deliver a product. Maybe it doesn't look so good. That's just one simple example. And companies are not required to divulge scope 3 emissions, but only scope 1, and in some cases, scope 2. You also can have differences in measures that give rise to dissimilarities in ratings because, for example, if we look at the S factor, the social factor, how do you decide if a company is being diverse in its hiring and pay practices? You might, for example, look at the number of women minority directors, or you could look at the differences in pay gaps between those two. Those are could be two very different answers. And so summarizing here, what we can tell is there is a problem. There are big challenges in how people construct portfolios because you can get these differences in how people decide on what metrics determine it. So now let's turn to looking at some of the evidence on the impact on returns and performance. And we'll look at a 2017 study on Norway's $1 trillion government pension fund, one of the largest in the world, and was one of the first implementers of SRI type of investing. And what this paper found was that the exclusion of stocks on ethical grounds did reduce the fund returns by a little more than 1% a year over the 11 years that they looked at. And they found as examples, just as economic theory would predict, if you screen out sin stocks, and you're not the only ones doing them, then these companies like tobacco and weapons makers are going to see lower valuations, which predict higher returns. And as you can see here, the screening out of tobacco companies costs the fund 1.2 percentage points a year, and screening out weapons makers also costs the fund about 1% a year. So let's now turn to reviewing the findings of a study that took a little different approach, one that we would favor because it looks at a factor-based approach to analyzing the impact of sustainable investing. Because it could be, for example, that tobacco stocks have higher returns because of their exposure to certain factors. So let's look at that evidence to see what we find. This study looked at the roughly 10-year period, 20-year period, 96 to 2016, over which the S&P returned a little under 8%, but a vice fund screening out tobacco, alcohol, gambling, the traditional sin stocks, returned almost 4% better. But when we looked at the data from a factor perspective, we also find that it outperformed by quite a bit, 2.5 to 3%, versus the CAPM 3 and 4 factor models. So it looks like there's alpha there, very much in line with what economic theory would have us say. But very interestingly enough, they extended the research to include the newer factors of investment and profitability. And they found that the vice stocks, because they tended to be more profitable and less wasteful with investments than the average company, were delivering higher returns. So if you could develop an ESG strategy that not only screened for ESG, but tilted the portfolio to all of these factors, you could neutralize, if you will, the negative effect from the screenings, but you would have to be willing to do that. And this is, in effect, what Dimensional does in its portfolios. It tries to tilt the portfolios to at least recapture some of that expected return. We're next going to look specifically at how investor preferences to avoid carbon risk, which is the big E in the ESG factor, has impacted returns. And so we're going to ask the question, do investors care about carbon risk? And they found that investors do seek compensation for holding the stocks of companies that emit a lot of carbon, the carbon premium, this sin premium, is economically significant, and returns increase as emissions increase. So the dirtier you are, the higher the ex ante returns or expected returns are. I'm going to come back to this issue a little later in the presentation. And there's also, it turns out, a significant carbon premium that you could say is related to carbon momentum, or the change in year-to-year growth in emissions. So companies that succeed in reducing their emissions can afford, of course, to offer lower stock returns because investors will favor them, their PEs will be higher and expected returns lower. And the reverse is true. So if you keep getting worse, more and more people will screen you out as your rating gets lower, and then you resign yourself to a higher cost of capital. All right, so now we're going to shift a little bit from the E to the G factor, the governance, and see what investors' preferences have to avoid companies with poor governance has on returns. So this was an interesting study done by Dimson, Marsh, and Staunton. They looked at returns in the post-2000 period for 49 countries that were rated either poor, acceptable, good, or excellent in terms of governance. And that means the more you protect shareholder rights and things like that, the higher your score would be. And so that tells you companies that have poor governance are riskier companies. They're more subject to fraud and corruption and all kinds of bad events happening. And it turns out, just as economic theory would predict, but maybe the opposite of what many would expect, companies that have the worst, or countries that have the worst governance scores, have the highest returns because investors are pricing for those risks. And there is a positive correlation between risk and expected returns. So the poorer countries, returned 11%. The other three categories earned between 5.3 and 7.7. So risk and reward are clearly related. The bottom line is that the markets are efficient, meaning that investors demand compensation in the form of higher expected returns for the risks of investing in both companies and countries with poor governance. All right, so let's review the two sources of a sin or brown premium: risk and taste. So we'll get this summary here together for everybody. So there's this risk effect. The responsible assets exhibit financial risk characteristics that appeal to investors, that reduce exposure to stakeholder risks such as consumer boycotts, fraud, human rights scandals, environmental scandals. It doesn't only affect the return side, there's a reduction in risk. So even if you get lower returns, doesn't mean you get lower risk-adjusted returns. And then you have this taste effect that people just avoid them, and that gives you the sin premium that we discussed. So let's summarize the evidence on sustainable strategies. The evidence says that firms with lower ESG scores exhibit higher expected returns. That's ex ante sense, before the fact. And investors recognize that increased ESG risks, and then therefore they demand a premium for accepting it. And companies, of course, pay a higher price in the form of higher cost of capital, giving them a competitive disadvantage. That's important to understand, because that means that ESG investors could be influencing how companies behave, and we're going to come to that shortly. So investors at the same time then are willing to hold firms that score low on ESG items if they are compensated sufficiently with higher returns. All right, so while there's evidence that sustainable strategies have a negative impact on returns, as we discussed, there's also evidence that they reduce risk. So from a factor perspective, it turns out that the higher scoring companies tend to be larger. They can spend more on ESG possibly. They have negative exposure to value, and that seems logical because companies that have poor ESG scores are, as we said, going to have lower PE ratios. That makes them value types of stocks. So that has a negative impact on returns, but they tend to be more profitable in general. Now, I did mention the sin stocks tend to be more profitable, but there's a lot of beyond the traditional sin stocks that didn't focus on the E, but were really on the S side. So S meaning social, not sin, but gambling, tobacco, and alcohol. So if you are green, you tend to be more profitable. And one of the reasons might be because you have a lower cost of capital. Your cost of debt might be cheaper as well. The sustainability issue also leads, as we've discussed, to reduction in risks. On the crash side, you have less bad tail risk events because the companies have better controls, and that leads to a higher valuation. Another important point is any benefit from incorporating ESG credentials into a portfolio, as we mentioned, is already captured by other well-defined and known equity factors once you get beyond the traditional size and value. And Dimensional, among other fund families, Bridgeway as well, AQR, and others, are now many of them including exposure to profitability, and have always included screens that in effect screen out companies that have high investment and low profitability, as DFA has always done. So that's going to give you exposure to those factors. So an ESG tilted process doesn't necessarily deliver lower risk-adjusted returns, and that's the good news here. For investors willing to tilt their portfolios, they get to express their social values through their investments without a penalty, at least in terms of risk-adjusted returns. All right, so now let's turn to the question I get often. Is ESG really, from an investment standpoint, affecting companies' behavior? Is my not investing in Exxon maybe impacting how they behave? And the answer is an emphatic yes. There's a whole chapter in my upcoming book, Your Essential Guide to Sustainable Investing, devoted to this subject. There are lots of studies on this, and they show that companies, of course, recognize that a high cost of capital puts them at a competitive disadvantage, and thus they seek to have lower cost of capital by improving their E, S, and G scores. And that leads to a higher valuation. And it does show that there's a positive ESG trend rating. Companies that have that are outperforming their benchmark, and a comparable strategy that tilt weights to companies with high ratings. So you could think of this as another example of momentum factor working. If you have positive ESG momentum, your returns are going to be higher. So companies can see that, and they could see the impact, and therefore I think we're seeing quite a bit of evidence that it is leading to changes in behavior, and you can exploit that as an investor as well. So the firm engagement is one way that ESG investors can influence company behavior. And when the employees see that, the evidence in some recent studies shows that it instills a sense of purpose in those companies. They're more satisfied, tends to motivate them, leading to higher profitability metrics, greater productivity. That's a way to enhance shareholder value. And ESG coupled with employee satisfaction has found to have a significant impact on company performance. So the companies that have the best ratings in both ESG and employee satisfaction, which now can be measured through natural learning AI processes, actually are delivering higher returns. So the effect here, again, is an easy way to think about it. By pushing green prices up, you get lower cost of capital. That allows these companies to invest even more in becoming even greener and gives them a competitive advantage, so that the brown companies then are faced with that competitive disadvantage and then try to improve their ESG scores or they would be at a competitive disadvantage. So let's summarize the impact here. And there are three key points. One is that expressing their values, sustainable investors are importantly having an impact. They can feel good about that, both on the companies and their environment. Investor cash flows, which lower or raise the cost of capital for companies with high or low ratings, causes companies to focus on sustainability, and those actions in turn lead to improvements in sustainability for all of us. All right, we have one last important point to discuss, and that's that there really are conflicting forces at work here. We get very different impact from preferences and cash flows on returns in the short term versus the long term. And this is really an important point to keep in mind. In the short term, the increased demand toward ESG changes the equilibrium. So investors say, I want to invest in ESG. I sell stocks that have poor ratings that drive, if there are a lot of people like me, that drives their valuations down and drives up the valuations of the green stocks. Well, that means in the short term, the impact is that these companies the green ones get higher portfolio weights, and that leads to short-term capital gains. But of course, the higher valuations in the long term means that expected returns are now lower. But that trend could go on for quite a while until an equilibrium is reached, when everyone's decided whether they want to be an ESG or not ESG investor. And as we've said, we've seen a massive shift over the last really about 5 years, since 2016, to ESG, with tens of billions of dollars moving into ESG. And that's changed the results that we see in studies. So all of the research up until about 2016-17 showed what I showed you in the Norway study, that tilting towards SIN stocks gave you higher returns. And there was a price to sustainable investing. The last 5 years with massive inflows have led to green stocks dramatically outperforming brown stocks. And that's actually had an impact on the value premium, because brown stocks tend to be value stocks. That could explain a significant portion of the underperformance of value companies. In fact, one study recently done found it explained about half of the underperformance of value over that period, 2017 through 20, when value underperformed in historic portions. But the longer term effect will be that those green stocks should have lower expected returns. So the question then for investors to think about is, where are we in this shift in the equilibrium? My view is, given that we're already over half the world outside of the US is green, if you will, in their strategies. The US has only moved more recently to become greener. We're at a third. We're probably somewhere, we're not in the very early innings, but maybe the middle innings of the game here. And it could be another decade or maybe longer until we reach an equilibrium. And what that means is that the green stocks could at least overcome their ex-ante lower expected returns, and yet deliver less tail risk and allow investors to achieve their sustainable objectives. Or if the trend is big enough and quick enough, they can continue to outperform as they did from 16 through 20 or so. So that's important. I don't think certainly we're near the end of this game by any means, but my crystal ball is always cloudy. So this slide shows you what we just discussed. Study looked at roughly a 30-year period, and it found that there was a dynamic shift in preferences causing a big change in when you looked at the data, and that's leading a lot of people to misread what the research is showing. Any study that's looking only at the most recent 5 years or so, or maybe even 10, will say green stocks didn't give up a premium or maybe even outperformed, especially if you looked at only the last 5 years. But that's not understanding this equilibrium shift. And you can see here in the last bullet, over that 3-year period where we had this massive shift, green stocks outperformed by 7% a year. That's massive. Now, that hasn't been the case. I think this year, certainly value has had dramatic outperformance as well. So we don't know exactly where we are. My own view is that there's good news for today's sustainable investors, because I don't think we're in the late innings. And if you want to get on a trend that is eventually going to lead to lower expected returns, you want to get on early as you benefit from those changes in valuations and pick up maybe even higher returns in the short term there. So let's summarize what we've learned. Sustainable strategies that don't take into account factor exposures should expect lower returns, keeping in mind this, we are going through a shift in the equilibrium. Sustainable strategies, however, also reduce risk. Thus, there may not be a sacrifice in risk-adjusted returns. And in the short term, as we've been discussing, the increased demand from sustainable investors might be more than sufficient to offset the ex-ante lower expected return as valuations of green stocks relative to brown stocks increase. Now, once a new equilibrium is reached, and we don't know how long it'll take to get there, lower returns to sustainable strategies, along with lower risk, should be the expectation, unless you adjust for factor exposures. So in closing, I offer the following suggestions. Because sustainable strategies impact both the risks and expected returns of a portfolio, and because each investor has their own unique set of values they wish to express, we think each investor should determine their own ESG frontier, meaning the highest Sharpe ratio for their ESG level, evaluating the costs and benefits of sustainable investing, and then construct a portfolio based on that frontier. So it leaves you with a couple of choices. One, you could make it a simple choice and work with already existing mutual funds like Dimensional, who don't screen out industries, but tilt toward the industries with better scores and try to keep those factor exposures. You could invest in a different way because you don't want to own any energy stocks or any tobacco or whatever it is that your tastes or preferences are. And you can find funds that do that. There are all kinds of funds available, even religious-based funds that screen to meet the preferences of that religion. Or because these things are so personal, we think the logical way is to build portfolios through the use of SMAs or separately managed accounts. And there are 3 families we work with, Dimensional, Aperio, and Parametric, that do a great job at reasonable costs. And they even add some tax efficiency benefits that are available in SMAs because you can harvest losses there more easily. And that's another great alternative that is available. So with that, we'll wrap up. Turn it back to you, Ian, for questions.
Thanks, Larry. I thought that was very helpful and some great commentary around the ESG world, especially it's become more and more popular with advisors and clients. We have had a few questions come in, and I'll start to fire them away over towards you, Larry, if that's okay.
Yeah.
First of all, so I think oftentimes when advisors and clients talk about ESG or SRI or sustainable investing, it's more geared towards the equity position of the portfolio. Can you talk a little bit about what's going on in the fixed income world as it relates to ESG investing?
Yeah, this one is really simple. Companies are issuing and governments are actually issuing green bonds now. So bonds that go to fund certain very specific products. Well, obviously, if you buy a German government bond that's non-green, or you buy one that is green, you have exactly the same maturity risk and exactly the same credit risk, and yet the green bonds are yielding less. So you are definitely giving up a price there to reflect that. That is also true. The evidence shows in the U.S. as well. But I do want to point this out that Moody's and others, Fitch, S&P, that rate corporate credits, they have recognized that there is ESG risk in the credit. So, for example, you get an oil spill in the Gulf Coast, that could affect Exxon's credit rating. So that they began in 2016 to have their credit ratings reflect already those ESG risks. So you've seen a narrowing of that spread. So at least for US investors buying corporate bonds, you're probably not giving up much, if anything, anymore. And you can invest that way. You can buy green bonds if that's your preference. But with government bonds, of course, you're going to give up something. But if that's your preference, it's perfectly logical for you to express your values in that way, but recognize that you are paying a price, if you will, in slightly lower returns.
Got it. The next question is just related towards fund versus SMA structure in the sustainable investing world. So with DFA Sustainable Core 1 portfolio, it has a little over 2,000 positions within it. And if you're going to build out a separate account, obviously that's a lot to hold in a separate account. What would be your ideas around kind of the minimum number of holdings you'd want within a separately managed account structure to mirror what DFA is doing within that Core 1 sustainable fund?
Yeah, so the question gets to how you want exposure to factors. If you want to say, I'm willing to own only large companies, you don't need that many stocks. A few hundred would be good, because large companies tend to have more systematic risk that's similar. When you get down to really small companies, you have a lot more what's called idiosyncratic or unique risks of those companies. And therefore, you need a lot more stocks. As a good example, when we designed with Bridgeway, their fund, Small Value, we wanted a fund that was deeper in size and value than the Dimensional fund for those investors who were willing to take that risk. We made a trade-off. We got less diversification because you're in a narrower segment of the market, but we wanted to have enough. So we set a goal, we set the parameters, so we get at least 600 stocks. We could have gone even deeper in size and value if we, were willing to accept less diversification, but there's always that trade-off. So Dimensional is going to hold a lot more stocks because they cover the whole marketplace. That's a good thing, I think, and that gives you some exposure to the size and value factors. The one other advantage of an SMA, which Dimensional can do, of course, as well, is you can tilt your portfolios more to other factors than, say, the Dimensional Core 1 strategy is, which has some exposure to size and value, but not as much as their, say, Small Value fund does. So if you want more of that exposure to increase your profitability and yet do ESG investing, you could do both. Use Dimensional, use their SMA. You pay a bit more, but the differences, I don't think, are really critical because you're going to pick up more premium, more than offsetting that extra cost. And you will get an increased tax efficiency.
Got it. That's helpful. Thank you. And then we had one more question come in. And if anybody else has further questions, please type them in the Q&A box. But just, obviously now that this sector of the investment world has seen growth, right? We've seen a lot of different avenues that clients can feel like they're doing good for the environment, for other endeavors. So one question came in just about SRI versus impact investing, and I don't know if you can talk through that a little bit. It seems the question related to the fact that both SRI and impact investing seem more tangible to companies, where the person submitted a question said ESG is a little more vague. But maybe just first I'll start just talking about SRI versus impact investing and kind of the differences there for clients and advisors to think through.
Yeah, we've got a whole chapter in our book on that. There's going through the whole history of the SRI movement, which literally goes back centuries. You can look in the Bible even, and you'll find in effect references to that. And among the first SRI investors were people like the Quakers, who wouldn't invest in any business that was involved, for example, in the slave trade in those days. So you go back hundreds of years here. But the original SRI were focused on what we would call sin stocks, right? It had nothing to do with the environment. No one was even too much concerned, and they weren't involved with governance. And then you started to get more social issues around, say, the South Africa boycott to get some action on that front. Impact investing is a very different thing. It tends to focus on making direct investments, say, in a water well in Nigeria to give those local town people good, clean water and access to that. And so your first consideration is not return on investment, but return from a social standpoint. And they tend to be much smaller, little investments, angel types of things and there are lots of people in that space really having great impacts around the world for companies that do that. But it's more specifically devoted to very direct impact. If that's your goal, that's a good way to do it. But it's hard to build a diversified portfolio of impact investing. It's going to be more one-on-one. There are firms like venture capital type of firms that specialize in this impact investing, and you're trusting them. They come up with the vehicle and say, all right, we've got this. We're looking to raise $1 million. Do you want to invest? And there are firms that do that as well. But it's very different than the broad SRI, which can be implemented in mutual funds, for example. But SRI is really a much narrower set. We like the term sustainable investing, which is even broader than ESG because it does include things like impact investing. And we do have a chapter on impact investing in the book as well to discuss that as well.
Great, thanks. You've mentioned the book a few times, obviously. Can you talk a little bit about that? I know it's set to be released soon. I know advisors have an opportunity to write a foreword for the book, I believe, and just if you can share a little bit about that with the.
Yeah, so just about a year ago, I've been writing regularly about the research on SRI, and as the demand from investors increased, the academic research increased right alongside of it. And I've written up now over 60 papers on this subject. We cover them in the book. So there'll be a great amount of academic research in the book, as well as the history of SRI, ESG, impact investing, and also telling people what they could do with it, like you can build an SMA and tilted factors. And we even recommend or provide some, portfolios as examples of what people can do. So I decided, we've got this great demand we're hearing from our clients, but there is no good book that really goes through, from our perspective, the right way to think about it is look at what the academic research says. And so I recruited Sam Adams, who's also passionate about this. He runs the only sustainable real estate investment fund, and he's been going around the world doing speeches at conferences. I've known Sam from his Dimensional days, and I said, Sam, you've got the knowledge of all the history. I've got the background in writing books and all of the academic research. Let's combine and put it together. And Sam agreed. And we've just literally today finished the book in terms of we've got a typeset copy. We've got a week or two to review, make sure there's no grammatical errors. But it is finished. The good news for the people on the call and the BSP community is I did make a special arrangement with Harriman House, the publisher, that any BSP firm can create their own forward. Very simple, have just their own name on it if they wanted, firm name. They can also have a forward, which Wendy Cook has written a canned for any advisory firm. She's in the process of writing that now. I think our fee is only like $250. So you can get a canned one, or for another small additional fee, maybe it's $350 or $500. She'll help you write a 4 or 5 page one that's tailored to your firm. You get your name on the cover, and you can order books at a discount for as little as 25 copies. What I want to mention to people is the book, because of supply chain problems, believe it or not, even paper in the US, the book was scheduled to be out in January. It's now pushed back to April. However, because of the ability to do small runs, they use a different publisher to print, or a different printer to make the smaller runs for the BSP community. So someone who wants 25, 50, 100 copies, we can get them that book much sooner. And importantly, if you order before December, I think 2nd, there's an extra like 20 or 25% discount because paper prices have jumped, and that's going to be implemented after that. So I think it's something like $11.50 a copy, if you order 25 books after that, but it's more like $9.50 if you do it before. If anyone's interested, just contact Ian, and we'll put you in touch with the publisher and Wendy Cook if you want help, writing a forward.
Yep. Yeah. And so for those that are on the call, obviously, if you work with BSP today, you would reach out to your regional support team, whether it's the regional director, the relationship manager, et cetera, and they can help facilitate that process. If you do not work with BSP today, but are interested in learning more about the book and perhaps writing forward and ordering copies, we are going to send out a follow-up email that will contain both a recording of this, I believe, and the slides, I believe, too. And in that, there will be a contact information link where you can reach out to the appropriate person at BSP to help with the conversation around ordering the books and the forward, customizing the forward of it. We did have one more question come in, Larry, and I know we have a few minutes left. So the question came in that currently some available ESG ETFs screen out 5% of their market cap, the weighted market cap of the portfolio through the ESG screens, where others screen out, up to 25% or more. And would you say that the expected return of the fund, which screens out more of the weighted market cap, would be lower compared to the funds that screen out less of the weighted market cap?
Yeah, I mean, that should be obvious. Again, because if you're screening out the bottom 5%, they're the bottom 5% with the worst Brown scores, if you will. And so they have the highest expected returns. And as you keep screening out, you're giving up more expected returns. So the more you screen out, the lower your expected return. However, I would say this, because of this dynamic equilibrium, the more you screened out over the last 3 years, up until 2021, maybe, you actually improved returns because you were getting greener. And as I showed, from 18 through 20, green outperformed brown by 7% a year. Now, there's no study yet, obviously, on 2021, but we do know is brown stocks tend to be value stocks, and value has dramatically outperformed this year. So my guess is, while there's still a big shift in the equilibrium, it's not that equilibrium shift has created bigger and bigger premiums for brown stocks. And maybe now that cash flow is not enough to overcome that? Don't know. All right. There's nobody who knows where you are in that equilibrium at any time. But as I said, my view is probably over the next 5 years or something like that, maybe longer, green stocks can at least maybe match the returns of brown stocks because of the cash flows, and maybe even outperform, and you do get less risk. But I think a good key is value stocks are still historically, they're at the 100th percentile, literally all over the world. It's 99% outside the US, and emerging markets, the US, we're at the 100th percentile. So as cheap relative to growth as we were at the height of the tech bubble. So you want to be tilted to value. So you can go green and tilt value. And then I think you get the best of both of those worlds. You get that shifting dynamic with the cash flows coming to green, helping you, but you don't miss out on the value premium if you're willing to do that.
Thank you. Well, that is all the questions we had. And I know we're close to the time that we said we'd hold this webinar to. So just to, I don't know, Larry, if you have any kind of final thoughts to recap. If not, I think you walked through it pretty well in terms of some of the trade-off and how in the short term that there could be more return on the green stocks versus brown stocks and that shift in equilibrium there and where we are in that spectrum. And then if anyone does have questions, feel free to respond to the email that's going out. You can also respond to the Zoom link that came in the email there. And from that standpoint, feel free to reach out to us. We're always here to help. Thank you for joining us today. And Larry, thank you for your time. I really appreciate it. I thought it was a great conversation. Yeah,
let me just add one last comment. There's been thanks to this natural language processing, artificial intelligence, there's been a tremendous amount of increase in using things like Glassdoor for figuring out employee satisfaction and the impact that has on stock returns. You're able to measure now this S. A fellow named Kai Wu at Sparkline Capital has done some great research, and I've written them up. They haven't been published yet, but for those of you who are not aware, you can follow me on Twitter and LinkedIn. Every time something gets posted for the 3 websites I write for, Alpha Architect, Advisor Perspectives, and Evidence-Based Investors. I think you're going to see a lot of really interesting papers on this S side, and I've written some of them up. So if you're interested in the topic, make sure you follow my Twitter account or LinkedIn. Either one will be able to do that so you can stay on top of all of the latest research on the E, the S, and the G.
All right. Well, thanks again, Larry, and thanks everybody for joining us. And look for future SWED Talks invitations I guess now in 2022 when we start to plan those out. So thanks again, Larry, and thank you for everybody for joining the call.